Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 12th and 26th. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Visit etfmarketinsights.com for more information. And remember to subscribe to our YouTube channel for fresh weekly content. Hit the alert button so you never miss a post.
Hey everybody, Larry Berman here, and here's what's on my radar this week. So here's the chart of the Treasury cash balances, and basically the X date, if you will, June 1st or slightly before. So unless Congress votes on something very early next week, there's going to be some last minute finagling here. There's talk of a temporary extension. I don't think either party wants to push this out into the budget talks in September timeframe. Inevitably, these clowns are going to wait till the last possible minute and cause the most frustration for all, on partisan lines. And we can bet that more than ever historically, well, the rhetoric is we want a deal. You can bet underlying it, and probably why the GOP walked out of the meetings today, is partisan politics has never been more polarized. So you've got this X date coming up. The U.S. government is not going to default on their debt and not pay their debt. It might be a day late. It might be a week late. It might technically qualify as a default, but at the end of the day, it's noise. U.S. government's always going to pay their bills. Question is how they get from A to Z. So, I don't think it's something, investors need to worry about from a, risk perspective, recession perspective, because I think that's coming anyways. The market, I think, is really grossly mispriced here. But to me, the follow-on here is when the debt ceiling does get reached or increased, they need to issue 1.2 trillion over the next 6 months of both bills and coupons. And here's the 30-year interest rate. You can see in the last month or two, it's slowly grinding higher. If it was about a recession, then interest rates wouldn't be picking up. They'd be rallying, and they're coming down. And the persistent message, again, that we heard from Powell in his chat with Bernanke on Friday was the higher for longer message. What he did change on Friday was the narrative of the systemic risk around banking and credit, and that if that were to get worse, it would be a reason for them to pause, and yet the decision hasn't been made. So with all the new coupon issuing to refill the Treasury General account, which we know in a couple of weeks will be out of money, bond yields need to go higher. They need to price in a discount to take down the increase in supply. And only question is how high are yields going to go? Are we going to break the extreme of last year's levels in the 30-year? Or will we come in somewhere lower? If I knew the answer to that question, I'd be one of those people that have all the money in the world, and I'm clearly not. But I do think we could get very close. 420, 425, 430, 440, somewhere in that range is probably where yields will need to get to digest the supply coming in the next 2 quarters. That will, again, suffice to refill the Treasury General account so the U.S. government can again pay their bills. So that will be a dynamic that right now equity risk premiums are not priced for. This week, the headlines, markets breaking out, the bears are stupid and climbing a wall of worry, fear of missing out, etc., etc. A couple ETFs here in an index I want to look at. Vanguard Total Stock Market ETF for the US market. So this is all the US equities, which is a combination basically of the Russell 1000, 2000, large, mid, and small caps. And so when you look at it on a market cap weighted basis, it looks like, you look at where we are now relative to the total return index here, we're looking at the peak in early February, bang on. If we're looking at large cap US, all will know that the S&P 500 made a marginal new high relative to the February intraday high this week. But if you look at the average stock on an equal weight basis, you get a very, very different message. And so again, a handful of large companies that are up 20, 30, 40, 50, 60, 100% this year are dominating the weighting in the indexes, and therefore making the market look a little better than it is. We can add the Dow Jones Industrial equal weighted in our market price weighted index in here, and you get a very similar message that the markets are more anemic than not this year. And it's really a large cap, handful of stocks that are really lifting and masking what is really going on under the surface. And that is the market, the average stock is more worried about it. So, you've got this dynamic playing out here where I just can't see it any other way other than it's a squeeze. It's a fear of missing out. Guys are chasing, continues to drive momentum. So what's the catalyst that's going to change that? Is it a default by the US, a technical default? Yeah, that'll matter a lot for sure. But ultimately, it's jobs and it's the consumer. So until we start seeing that unemployment picture get worse, the employment picture get worse, then we're not there. Bloomberg interviewed Claudia Sahm, who was a former Fed research staff, and she created this indicator. And the indicator basically looks at the rate of change of the unemployment rate. And we're nowhere near a recession, but every single time we've got the setup for it. So we're there, and it's not until I think we see those job losses start that the equity markets and therefore earnings will start to reflect a harder landing. And for now, the narrative is a soft landing. And I think it's completely wrong in terms of where we're going to end up at. So again, as Bernanke and Powell were talking today, the higher for longer message, what happened in terms of the yield curve. We still have about 2 rate cuts priced into the curve by the end of the year, 2.5 roughly by the January meeting. And that just seems extremely unlikely unless equity markets collapse or unless credit markets seize up. The Fed feels they need to stimulate and ease, which they're just not going to do until inflation comes back towards their target and or equity markets sell off. So where do we look? Where's the bull story right now? Last week we talked about natural gas. Some of the names we mentioned had a very, very good weeks. We think there's a lot more juice there on the natural gas side, and we still like it. Searching the stock patterns today, we see this really nice bottom forming on Alibaba, and you get this bottoming head and shoulders, multi-head and shoulders pattern building. If you look at a breakout situation, we're not there yet. This is anticipatory. But what did we do today on the pullback? We added some more exposure to Alibaba and maintained the weight in our portfolios. And when you look around the world and say, how many stocks potentially looking out to the end of 24 have a potential double in them? There's not a whole lot given the US large cap equity strength led by technology. I like Alibaba here. The breakup of Alibaba should release a lot of value there, and we should ultimately see a retracement here back towards those resistance levels, and you can see some of the targets we've highlighted here. In terms of where we want to be cautious, interest rates. If interest rates are going to go up, gold's going to lag. If gold's going to lag, and equity and the economy is going to turn down here, then equities don't look good either. Cautious on asset prices in general here. Cash is king for now. Have a great weekend.
Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 12th and 26th. Check out these two exciting two-part events, which we curated specifically for you, the DIY Investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Visit etfmarketinsights.com for more information. And remember to subscribe to our YouTube channel for fresh weekly content. Hit the alert button so you never miss a post.